Good afternoon. I'd like to welcome everyone to our quarterly virtual event talking about inflation, taxes, and year-end planning. So we'll start out with our normal introductions. Then we will have a review of the equity and the fixed income markets, as well as some year-end tips and kind of what's coming up next in the market. First, just to introduce myself, my name is Derek Cattell. I am in charge of wealth and sales here at Victory Capital. I've been in the investment business for over 20 years and have been leading these efforts here for the past year. And Victory Capital as a whole, we are a global asset management firm with over $160 billion in assets under management. We are publicly traded on the NASDAQ with a ticker VCTR. And the Wealth Advisory Group specifically is a dedicated relationship with one-to-one between yourself and a wealth advisor. The Wealth Advisory team as a whole has over 270 years of combined investment experience, including several certified financial planners and certified investment management analysts. And as a reminder, all investment guidance is provided as a courtesy to our valued clients. A couple updates from our previous webinar is the Victory Capital mobile app is now available on both Apple and Android devices. So if you have not, please go to the Apple Store or the Google Store and you can download those. Additionally, we have just created some new income-oriented portfolios specifically designed for equity income, taxable income, and municipal income portfolios. We actually have 7 portfolios total that we have created. So if you have questions on those or looking for ways to generate income, please reach out to your wealth advisor and they can go through those with you in more detail. Introductions. Jim Jackson is going to be speaking on the fixed income component. As a reminder, Jim is the head of fixed income portfolio management here at Victory Capital as part of the USAA investment franchise. I would also like to introduce Kelly Cliff. Kelly is president of the investment franchises for Victory Capital and has been working at Victory Capital for a little over 9 years. So Kelly, with that, I'd like to turn the floor over to you.
Thank you, Derek, and welcome everyone. I would like to give a little more introduction to Victory Capital for those who are not as familiar. The slide being displayed right here is basically the crux of our business model. And what that is it's an integrated multi-boutique investment platform. We have a bunch of autonomous investment teams that execute their own investment process, their own investment philosophy, and do it in very specialized asset class areas. We think this is the most effective approach for enhancing investment outcomes without having groupthink or a house view, if you will. I'm president of investment franchises, and I work with all of these franchises and manage the asset management group. And with that, I have some views that I will be sharing with you today on inflation and equities. So I guess I want to start off with a little bit of an objective approach as to why are we talking about inflation. I understand it's in the news and it's a headline issue, but the reality is that most people in their investment careers have not dealt with significant periods of inflation. We haven't seen inflation since the 1970s. It was really ruled out by Paul Volcker in a pretty aggressive move in raising interest rates. And I say that because raising interest rates is the convention that most people associate with dealing with inflation. But the reality is that, and many ascribe this to innovation and technology, we've actually have not seen a lot of inflation since the 70s. And as this chart shows here, over the last 15 years or so, inflation, and there's various measures on here which I'll speak to, but inflation, as far as the Fed and economists look at it, has pretty much run close to its 2% rate. I'm showing the CPI total, which includes some very volatile parts, which are food and energy, which often don't necessarily connect directly to economic demand or growth. Food can have issues with weather and drought, and energy can have geopolitical risks. So that one has been very volatile, but it's also kind of trended sideways. The other measures, which are core, which exclude the energy and food elements that can be more volatile, have kind of hovered around the 2% range. I mean, it came down a little bit after the global financial crisis, but it's basically kind of trended about at the 2% line. And quite honestly, the last time we had this raised conversation about inflation was after the global financial crisis, when many were worried that a lot of the stimulus and low interest rates would end up in an overheated economy, an over demand for goods, and an environment for inflation. As you can see, that didn't really pan out. What is different now that's making it hit the headlines? If you look to the far right of this chart, you can see that all the lines spike up. And this is actually something that we haven't seen synchronized like this since the 70s. And we obviously have seen an environment that is unusual with the pandemic. And so we're going to drill into this a little bit more, but I would suggest that until the pandemic hit, deflation was probably the biggest concern of the Federal Reserve and investors as opposed to inflation. And now we have this this new phenomenon that could be quite challenging. Now, Derek, I'd like to show this more globally. So this also exists in the Eurozone. And you can see that the patterns of total inflation and core inflation are largely the same as what we've seen in the US, which means that this phenomenon of the spike in inflation recently is global. I think in the past, many have viewed very inflationary markets as being very local or regionalized, something going on within that specific country or that specific region that's driving it, whether it's politics or whether it's something else. But this is quite different in the sense that it appears to be quite global, and given that the pandemic was global, I guess that's not too surprising. So now I'd like to kind of zero in on the pandemic. I think I've established that this inflationary environment appears to be different than at least modern history, but has the concern of many that the last time we had this concern was 50 years ago in the 70s. And the way that we've been viewing this is, if you look at the chart in the middle, this is data from the CDC, and it shows the infection rates, and the line is kind of a moving average, 7-day moving average, to just kind of give you a sense. And what I'd like to do is just carve this up into 2 chapters. I think the first chapter is the beginning of the pandemic to the vaccines, which I'll call maybe like March, April, May of 2021. And then the second wave is at the end of that chart at the top, where in the summer of 2021, we had a spike in infections. And if you look down to the bottom left chart, the time periods are much the same for these popular inflation measures. And you can see that when the first wave hit, expectedly, we had inflation actually decline. You would think a pandemic and a lockdown and businesses not being able to stay open would have a deflationary pressure, and they did. And that it stayed pretty flat until the vaccines kind of rolled out. And I think there was a lot of optimism that things were coming back to normal. We, you know, we had a lot of challenges with dealing with how we're going to get back to work with vaccine protocols, people receiving stimulus. There was a lot going on. And then we hit this second wave. And I think what's unexpected is that in the second wave, things actually accelerated. We went into the summer of 2021 with a second wave and infections increasing dramatically, but we're also entering that wave with many being vaccinated, with death rates associated with the number of infected being much lower than that first wave, and a lot of people, quite honestly, working from home and being able to buy stuff because, or wanting to buy stuff, TVs, computers, printers, whatever it was, and using their income on those types of things as opposed to going to travel or to go to restaurants or do leisure activities because we were in lockdown mode. And this spiked all of the popular measures that we saw on the previous chart, and in a pretty dramatic way. And if you look at the bottom right chart, it sort of corroborates this story that employment spiked up, it started coming down. The participation rate, which is the orange line on the bottom right, has recovered somewhat, but not to pre-pandemic levels. And average salaries have recovered somewhat, but not to pre-pandemic levels. So there's sort of a societal shift that's also occurred with this pandemic, where it seems like we're having a hard time, while consumer consumption has dramatically increased during the second wave. We haven't been able to meet that demand with supply with businesses, as there's been a shortage of labor. There's been we've all heard about the supply chain issues. There's been a rise in just running your business as far as energy costs. And so businesses have a really hard time meeting the demand that we saw from the consumer. The consumer turned on like a light switch, and the businesses were not necessarily able to turn on like a light switch during this second wave. And that's something that we think that is kind of interesting and actually presents maybe a longer term challenge than what the Federal Reserve has been calling as transitionary. Many of the inflation indicators have been involved in the more transitory areas, energy, food, leisure, but we're seeing it a little bit broad spread too. And I think it's the impact of having a demand for product just go back to full steam in such a short period of order without businesses being able to adjust their inventory, adjust their labor, and adjust to meet the capacity needs of the consumer. And that is how we've kind of viewed this this pandemic and the uniqueness of this inflationary pressure that we're seeing. And we view it as being a risk of being a little bit more long-term. I think today or yesterday, the Federal Reserve came out with an expectation that 2022 would have inflation in 2%. Now that's about half of what we're running at on a year-over-year basis right now. And given the information that we've looked at, that seems kind of challenging. Now, I'd like to relate this to the equity markets, if we could, Derek. So if we go back to breaking down sort of the pandemic into the two waves, the first wave that takes up the first 2/3 of the left to right chart at the top, and then the second wave, sort of the last third of that chart. And when the pandemic hit, it was a continuation of growth stocks and stay-at-home stocks and stocks that could continue to generate earnings without having physical contact with their consumers, if you will. And so we saw, and this was a global phenomenon, we saw large cap growth stocks, small cap growth stocks, international growth stocks, emerging markets growth stocks, all do well with the start of the pandemic. And if you look at the two charts at the bottom, this is value relative to growth. So as the lines go down, that means that respective component is growth is doing better than value, or value is doing worse than growth. And we saw this in a precipitous way. It had very little interruption through the first wave of the COVID infections. After the vaccines, we saw a much more positive reaction to the reopening story. The story that people have been locked up in their houses for such a long period of time that there is a huge demand to travel, to go to restaurants. We're seeing hotels expand capacity from 40 to 60%. We're seeing more discretionary leisure spending that results in going out than staying home, if you will, in a lockdown mode. And you see on the left bottom chart, a lot of those lines start spiking up, and they're spiking up in a meaningful way, and almost on the small cap side, almost has recovered everything since the pandemic started, as far as small cap value stocks versus small cap growth stocks in the U.S. That was in response to what we were seeing on the rise in inflation. So these particular stocks in the value sector were direct beneficiaries of prices rising for their goods. Now they have input costs that are rising as well, but at least they're able to pass on, presumably, the increased cost to the consumer and still generate meaningful margins. On the bottom right chart, I'm showing this for developed international markets and emerging markets. And we didn't see this as much, and it makes sense to us because the infections, the vaccines, is still a little bit more out of control than we've seen in the US. And so we've seen glimmers of value coming back as far as the reopen trade, but not as much as versus the US side. So I'd like to add some comments as to whether this is transitory or not. And if we're honest with ourselves, the reality is all inflation is transitory, and because transitory doesn't have a maturity or a time frame. But if you believe in supply and demand, if there's it will ebb and flow over time, and things. And so the reality is to think about, well, what's different in this inflationary environment than what we've seen in the past? And what's different here is the pandemic has added a little bit of a societal change, if you will. I think there was a bigger importance on the quality of life and people wanting to invest in their homes, thinking I'm going to be working from home a lot. I want to do a lot of remodeling, or I want to buy a bigger home, or I want to buy a home with a bigger backyard. We saw real estate values really ascend during this period, and it was a very low interest rate environment, so it was very conducive to that happening. And real estate's usually viewed as a very sticky component of inflation. People who rent out apartments, their apartment rent doesn't get changed every week or every day or every month. It's usually yearly. And we see these things ebbing up, which makes us think that there may be a longer runway here for inflation, because the sticky components don't adjust so quickly. And we also are starting to see an increase in wages. and wages are not necessarily a very variable component to people's lives. Usually, those are very sticky. And once a company increases wages for its employees, it's very difficult for it to change that. So what we're showing on this chart here is in the top right, Federal Reserve of Atlanta. They did something kind of interesting, and this was a little bit more of an augmentation of a previous author's. But they took all the components in the CPI index, and they tried to break it up by what was sticky and what was flexible price increases. And this was just the variability of the price increases for each component. And it's up and down. So it's just trying to say, you know, is this pretty variable or is this pretty sticky? And they broke the index up into those, and I show that the two the price level increases over time, year over year, with those two components. As you can see, the flexible component, as you would expect, really increased dramatically in the most recent period. Now, I also would say, though, that the sticky component actually spikes up a little bit. If you look at this period of time, that's about 15 years since the global financial crisis, the sticky components really increased dramatically. One of the parts of the sticking component is real estate, and I mentioned real estate earlier. And the Federal Reserve of Dallas put out some statistics that we're showing at the bottom here. So some of the popular gauges of inflation are given in the bottom left, and how much the contribution to those inflationary measures are to those respective indexes. So to just go to the most dramatic one, owner's equivalent rent for core CPI, the far gray bar on the right, it's over 20% of that index is contributed from owner's equivalent rent. And then the chart to the right shows, well, how has rent inflation related to assume home price growth? And it's been a lagging indicator, but as you can see in the far right part of the bottom right chart, the blue line that's the Zoom home price growth has really spiked in the recent years. And that's back to my earlier comments about there was a cultural shift about home ownership and whether you're going to be working more from home and you want your home to be more desirable than pre-pandemic. And we haven't seen the inflation component respond to that yet. And so this makes us think that we're at least into a 2-3 year what I'd call structural increase in inflation. I don't think it could stay at where it is at, close to 5-6%, but I think it's going to definitely be north of 3%. And so I think this is why this is different. And the pandemic has really shown us that it's hard to respond to very quick consumer demand, and it's going to be very hard to fix all the supply chains over a very quick period of time that phenomenon has created. So let's go to the next slide and talk about what you do. Now there's obviously many instruments that are hedged to inflation. I guess US TIPS would be Treasury Inflation Protected Securities would be sort of an obvious one. I would caution at the moment to just say that those are very richly priced at the moment. And the government owns, the Federal Reserve owns about 25% of the outstanding issuance of US TIPS. So that's definitely a more direct inflation connection. But I think there is a distortion in the market. And if the Fed does start tapering, they're going to be sellers of tips, which is not necessarily the best thing. But I think something that people underestimate is equities can be a great place to be during an inflationary environment. Now, historically, value has done pretty well in periods versus growth in periods where inflation is like around 3%. The very few periods that we've experienced in the last 50 years where inflation has been like above 5 or 10%, those are very few periods, but equities in general have not done very well. But if you think about the current environment, and considering the relatively richly priced parts of the US tips market, the equity markets might be a good place where inflationary costs can be passed on to the consumers, and these companies can preserve their real after inflation profitability, if you will. This is something that is probably more probable in our mind, given how low interest rates are at the moment. And there isn't a great amount of indebtedness on US corporate balance sheets in general. I would also say that you need to be mindful of diversification. We've been in an environment where growth has dominated value for so many years that popular index funds like the S&P 500 have over 22% of the index in the FANG plus M stocks, which you all have heard about on the news. And those stocks aren't necessarily positioned to participate in inflationary environments that are connected to a cyclical economic recovery. So I would be cautious. Equities might be a good spot, but a more diversified, broad exposure to the equity markets that include financials, materials, industrials, and commodity-related equities could be a promising place to be during an inflationary environment. So with that, I think I'll hand it over to my colleague, Jim Jackson, and let him give you a update on the fixed income markets and his comments about inflation.
Thank you, Kelly. It is a pleasure to speak with all of you once again. The third quarter in fixed income has four broad takeaways. First, fixed income returns were mixed as the Treasury curve flattened and credit spreads widened. So the Treasury curve, just to explain that, consists of basically a plot of Treasury yields from 3 months to 30 years. What we saw in the third quarter is Treasury rates in the middle part of the curve, the 5 to 10 year part of the curve, increased, and rates on the longer end of the curve, the 20 and 30 year part, decreased. So the slope of that line flattened over the quarter. We also saw credit spreads widen. Credit spreads are the incremental compensation you receive to take credit risk, for example, to buy a corporate bond versus a Treasury bond, and spreads widened slightly during the third quarter. Second, the consumer price index remains elevated and above the Fed's 2% average long run objective. Third, the employment market, though improving, still trails pre-COVID strength. And fourth, recent economic numbers are weaker than expectations for the first time this year. So to get a broader view of fixed income performance, on the next slide, corporate high yield was the strongest fixed income asset class in the quarter due to its low interest rate sensitivity and higher levels of income to compensate for increased credit risk. Treasury bonds in the US aggregate had small gains in the quarter due to lower long-term Treasury rates offsetting higher yields in the intermediate part of the curve. Corporate bonds were flat as the flattening of the curve and slightly wider credit spreads offset each other. And finally, muni bonds were the weakest performing asset class on higher yields, which are inversely related to price. Now, on the next slide, we have our corporate credit market monitor. There's a lot of data on this slide, so I'd just like to point a few things out. First, not only was high yield the strongest performer for the quarter, it was also the strongest performing asset class for the year. Second, excess returns, which are the returns relative to duration neutral treasury bonds, are positive for the year across all fixed income asset classes, but they were mixed for the quarter. The final thing I would like to point out is that the amount of incremental compensation you're receiving to take credit risk has compressed, not over the quarter, but throughout the year. So the biggest topic in the markets has been inflation, which we look at on the next slide. So although inflation remains elevated on a year-over-year basis, as you can see on the right-hand side of the chart, we started to observe a couple of notable trends. Month-over-month CPI changes have come down off of their peaks. So we started to see year-over-year increases over the last few months firm in the mid 5% area. What we've also started to see is the contribution of sectors that were most impacted by COVID has declined each month since peaking in May. So in May was the peak of the so-called base effects of inflation, where industries that were hit particularly hard in March, April, May of 2020, the increase in CPI from those peaked in May. And since then, the contribution of sectors less impacted by COVID has broadened. So inflation trends in general are broader now than they were over the last few months. So the big question over the coming quarters is whether CPI starts to move back towards the Fed's long-term target. Now, as we turn to the next chart, it shows market-based expectations for inflation. So the darker blue line is the US 5-year Treasury break-even rate. So this is a market-based expectation for inflation over the next 5 years. So what we have seen is that that number was fairly stable throughout the third quarter, but it did end the quarter at 2.53%, which is higher than the Fed's long-term average target rate of 2%. So the market is expecting inflation to come off of its peaks, but over the next 5 years to still exceed the Fed's long-run average target. The next primary data that the Fed looks at is employment. So on the next slide, we show on the left-hand chart is the unemployment rate and the participation rate. So the participation rate has been at or below 61.7% since April, which is well down from 63.4% in January 2020. So what this means is that the amount of people participating in the labor market as a overall percentage of the population has decreased from what we saw pre-COVID. So even though the unemployment rate has been ticking lower, we will need to see continued improvement in both the participation rate and the unemployment rate for the Fed to determine the future path of monetary policy. Now, all of this obviously has caused a lot of changes in economic data throughout the year. So this chart shows the Citi Economic Surprise Index, which is the dark blue line. The economic results for the first 2 quarters of 2021 generally beat expectations. So this chart is above 0 when that happens. This coincided with an increase in earnings estimates. So stronger than expected economic numbers led to higher earnings expectations. However, as COVID cases increased in the third quarter, economic results started to trail expectations and earnings estimates stopped increasing. So how corporate earnings develop in the coming quarters is a key metric that our team will be looking at. So this was a lot of data that you've seen today, not just in my comments, but in Kelly's comments, and they both beg the question of what do I do now in fixed income? So if we can turn to this next slide, we think that the answer to this question is consistent regardless of whether rates are high or low or inflation beats or trails expectations. The first thing is that you should focus on generating income, as income is the primary driver of fixed income returns over time. Second, you should ensure that your interest rate exposure matches your risk tolerance. Third, don't make bets or portfolio changes based on expectations of moves in interest rates, as this sort of market timing rarely works. And finally, stay invested in fixed income. Even though rates are low, fixed income is a time-tested portfolio diversifier. Thank you very much for your time, and I will turn it back over to Derek.
Thank you, Jim. I appreciate that. Just want to touch on a couple things here as we wrap up the year, and we touch on everyone's favorite subject, which is taxes. We received a lot of questions regarding what's going to happen with the proposed tax laws. And in general, I'd like to just say first, avoid over-planning. Right now, there's a lot of proposals, but they're just that, they're proposals. We don't know exactly what's going to be in the final bill, nor do we know what the final bill is going to look like when it passes. But we have seen a couple trends that have happened. One being the top income tax rate increasing to 39.6 from 37%. It also seems that qualified dividend income and long-term capital gains are going to have a tax increase next year. And those numbers have ranged anywhere from, because that is currently 20%, I've seen numbers on that ranging anywhere from 25 to go significantly higher than that. Conversions for your IRAs. So Roth IRA conversions will be blocked if you have certain income levels starting in 2022. Again, this is a proposal. And so the result is, first, consult your tax professional once the bill gets closer to passing, and then does pass. Then certainly in conjunction with your tax professional, talk with your wealth advisor and executing certain strategies that can help minimize that. Expectations on the bill right now currently seem to be late November, early December, to when Congress finally gets serious about trying to get this passed. A couple of reminders also as we wrap up the year is make sure you have completed any required minimum distributions that you have. Also, another thing that you can do is charitable giving. That's a way to help minimize taxes if it's in a taxable account, for example, is you can donate securities to the charity as a way of passing that along. Also, as we've seen volatility happen, as both Kelly and Jim have touched on, is make sure you're working with your wealth advisor to make sure you're taking the appropriate level of risk for your investment goal that you're trying to achieve, and make sure you complete that portfolio review. One last thing just to touch on is capital gains estimates for the funds are coming soon, so keep an eye on the website over the next week or so, and you will be seeing those. So I want to turn a little bit to questions. Like I mentioned before, we've had a lot of questions that have come in from the group, so very, very appreciative of that. And one that came up more than any other is something that both Kelly and Jim touched on quite a bit, which is inflation. But I'd like to turn that a little bit of how, both Kelly and Jim, how can we protect against inflation in a broad stroke? I know every individual circumstance is going to be specific and unique, but what are some strategies, what are some asset classes that perform better in an inflationary environment versus not? So Kelly, I guess, can you start with that one?
Yeah, sure. Thanks, Derek. I guess to harken back on my earlier comments, and this may not sound too clever, and sometimes I don't. I think it's better to not try to be too clever. Is that, I think equities have a role in an inflationary environment, and possibly an attractive role. I think that the 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 consumer is in a healthy position. Consumer demand is actually what we're facing. And to the extent that companies can pass on the cost of inflation, if you will, to customers, that that should provide a real return or an after-tax positive return. I think that that needs to be done in a broadly diversified way. I wouldn't necessarily say, well, I want to go buy only energy stocks or only want to buy real estate stocks. I think that's very risky and has the potential, like for energy, to have a very short-term correction in that area. But I do believe broad-based inflation, as I said earlier, is here for longer than what you hear in the news, from my perspective. And so having a broadly diversified portfolio into a lot of sectors that quite honestly have been out of favor for like 10 years would be an advisable inflation hedge.
Thanks, Kelly. And Jim, can you kind of touch on the same thing from the fixed income perspective? What are some things that our clients can do at broad stroke and as an asset class that can help protect against inflation?
Sure. Well, obviously, fixed income is the returns are generated by the income that is generated from the bonds that you hold, and that fixed level of income is eroded by inflation. Now, within fixed income, the asset class most susceptible to that is treasury bonds. They are a rates-only driven asset class. What is least or what performs better than treasury historically is corporate bonds, where the correlation between increases in interest rates and the incremental compensation you receive for investing in corporate bonds and other forms of spread product is negative. So when rates increase, historically, credit spreads either stay flat or go down and support the pricing of your bonds. And they also provide, and this is important, an incremental level of income relative to treasury bonds. So this has been a focus for us across all of our fixed income products.
Excellent. Thank you, Jim. Second question that I will address as well is we had several questions asking about cryptocurrency as an asset class and just how to invest in it. And one of the things that I would just like to mention is be on the lookout. We will be hosting a virtual event on November the 3rd, touching on just that, cryptocurrency as an asset class and ways to invest within it. So stay tuned for invitations on that to be coming within the next couple of days. So back to Kelly. I know you touched on growth and value both domestically and international. Can you touch on, Kelly, maybe some areas where you see opportunity, both domestically versus internationally, where you see places to invest right now?
Yeah, thank you, Derek. So I don't think it's too much surprise to any that U.S. value equities are still trading at a really attractive discount to U.S. growth equities, even with some of the recovery that we've experienced recently. The the valuation disparity is, about 1.5 to standard deviation event versus history. So, and that definitely aligns with the reopening. It definitely aligns with the rise in inflation. So I think revisiting your portfolio and making sure you're balanced between growth and value is probably the most advised. And also international has also been at a discount versus US, and broadly I'm talking about like growth and value. And so I think taking in it, making sure that you're broadly diversified between US stocks and non-US stocks is wise and kind of low-hanging fruit at this moment, in my mind. And and for those that are worried about currency exposure, I would also just caution that I think diversification is the key there. We've seen the dollar fluctuate pretty wildly versus some of the main G7 currencies over the last year, where at the end of the day it kind of ends up where it started, but there's a lot of volatility on the way. There's a lot of discussion, well, deficits in the US should crumble the dollar, but the reality is that the deficits abroad are probably proportional to the size of their economies as well. The idea that at least interest rates in the US are higher than abroad, that's true, but inflation is not countered into those measures, and that needs to be taken into consideration. So my goal in dealing with the foreign currency issue when allocating between US and non-US stocks would be to just make sure you're diversified.
Great, thank you, Kelly. Question for Jim, specifically with bond funds, is what happens to bond funds when inflation causes new bonds to pay a higher interest rate and older bonds mature, and then the current bonds do decline in value? And so overall, how is all of that going to affect a client's income?
So the direct impact of inflation on bonds and the amount of income you receive from your funds, that link doesn't really exist. It is more the overall level of interest rates. So if we've seen interest rates creep up in the last few months, and to the extent that we have bonds that, say, for example, were purchased 10 years ago and that were earning 5%, when they mature and you get your money paid back and you buy new bonds and those bonds are yielding 3%, the overall yield of the portfolio will go down proportionally. Now, I should caution that our funds hold hundreds, if not thousands, of bonds, and they mature over long periods of time. So that risk, the extent that bonds are maturing and being replaced by lower yielding or higher yielding bonds, occurs over a very long period of time, measured in multiple years, depending on the funds. Now, the existing price of a bond or a collection of bonds will be directly impacted by a change in interest rates. And as the yields or rates go up, you would expect, all else being equal, the price or the NAV of the fund to go down.
Excellent. Thank you, Kelly. I appreciate that. And that wraps up our questions for this afternoon. So I appreciate Kelly, Jim, everyone. I very much appreciate your time. Thank you for joining us this afternoon. Please, if you have any questions at all, please reach out to your wealth advisor directly. Also, don't forget to visit us online on both Facebook and Instagram. And like I mentioned earlier, be on the lookout for an invitation to our cryptocurrency virtual event, which will be on November the 3rd. I hope everyone has a great rest of your day, and thank you very much.